I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minutes for November 3rd, 2013. Stocks were up a tiny amount last week, thanks to a Friday afternoon rebound. As expected, the S&P poked its nose to a new high before retreating. Last week's catalyst of the Fed's meeting and the latest jobs report, which are nearly automatic rally occasions, were on the weak side this time around. The Fed rally was already spent by the time the bank made its announcement, and the jobs report rally had to struggle for half the day before it was finally able to get into the green and stay there. To me, that's a sign that the market is getting a little tired right here, although the urge to sniff for higher highs hasn't yet been completely extinguished. Price action could be a little random this week while we wait for the two big market-moving reports, the first estimate of third quarter GDP on Thursday and the first estimate of October jobs on Friday. The general thinking for real GDP is that it will come in at about 2% annual rate, although the range is fairly wide. Last quarter's headline result of 2.5% benefited from an unusually low inflation factor, one that I don't believe, as it claimed inflation was running at a 0.6% annual rate. That's about half the rate of the Consumer Price Index and about half the rate of the other inflation measure used by the same Bureau of Economic Analysis that calculates GDP. Past experience suggests that this rate will quietly be revised higher about a year from now, when no one will care. That said, the odds do slightly favor another Goldilocks type number. In other words, if the initial headline number is a little bit below 2%, that's good because it keeps the Fed in the game. If it's a little bit above that, it's good because it means the recovery is accelerating. That goes for the jobs report the next day, too. The consensus on the street is for a number of around 120,000 new jobs. Well, that would be a decline of 20 or 30,000 from last month, but since we can blame it all on the government shutdown, the market shouldn't feel too bad unless the number drops below 100,000. Now, in my own estimation, the real number could well be below 100,000, but the department's estimate could well be above 120,000. I don't believe that the Labor Department is cooking the books. It's just my own inference from studying the estimation results they've been using for 2013. However, the next report does come with a preliminary benchmarking revision, meaning they're going to reanalyze the last 6 months, so there could be a general reset. Be ready for anything. Overall, the market is still overbought here and ready for some sort of retreat. It isn't real overbought short term though, and the market nearly always goes up on the day of a jobs report, so my thinking is that the odds favor prices trading in a narrow range this week, maybe a little up, maybe a little down. I'm Kevin Flynn, and thanks for listening to another edition of Avalon's Market Minute.